Hello and welcome to this edition of Closing Trades. It's quite the bloodbath out there, and more importantly, it doesn't seem like it's going to abate anytime soon. Firstly, a check on how Asian markets have actually panned out. While we are down 900 points for the Nifty, and that's a good 4% cut that you're currently seeing, you've just seen very few whiskers, if you will, of any sort of rebound. We've continued to be gapped down. 22,000 is what we're just defending as of now. Look at how Asia closed. Japan lost 2,600 points. That equates to a near about 8% cut. Hong Kong lost 13.25% on close. And Shanghai, which came after a day's break after Friday, lost about 245 points, and that's a near about 7.5% cut. Similar was the case for the Kospi as well as the ASX, which have also seen very deep gashes. Europe markets, they've also come into trade, and what a Monday it's turning out to be for them. 5% lower for FTSE, DAX down nearly 6%, 5.6% down for CAC, FTSE MIB down 6%, Stock 600 down 5.5%. And this is not it, because look at how the US futures are panning out after that vicious sell-off that you had on Friday, still lower by 1,200 points. Of course, it's 1,000 points better than what you had on Friday for the Dow, but S&P 500 down another 170 points, NASDAQ almost hinting at an over 600-point decline as well. But another important observation that we were making in the morning, and Kunal was noting that every time the Dow has stayed below the 3 standard deviation range for a few consecutive days, it was always followed by major consolidation. Kunal is back here in the studios to try and explain how this phenomena, Kunal, really works and how does it now fit in the current scheme of things.
Yeah, thank you so much for that, Aisha. So, let's first understand what is the 3 sigma Bollinger Band. It's basically an iteration in which 99.7% of the observation approximately fall, below that range. So, any exceptional or over exceptional kind of scenarios, they generally get extrapolated into this kind of a Bollinger Bands. Now, interestingly, we've looked at the last 120 years of the history for Dow Jones, and when the Dow has actually fallen below this 3 sigma Bollinger Bands and what has happened post that in the short term as well as in the medium term. So, for example, in 2015, we had a very similar scenario where, the Dow Jones prices for 3 consecutive days of the sell-off, we fell below this black line, which you can see is the 3 sigma Bollinger Bands. And, when that happened, that resulted into the index going into first a sideways consolidation, which means that the pace of sell-off looks to be at an extreme. It feels that, we are in the eye of the storm. But post that, there is a first phase where the index subsides, goes into a consolidation for a few weeks, months, and then starts a gradual process of a very strong recovery, thereby surpassing the previous starting point of the corrective highs. This was in 1998 also, where we'd seen a similar observation, where for 2 or 3 consecutive days, Dow had fallen below those long-term standard deviation bands. Then comes to 1952, a similar kind of an observation where the Dow had fallen below this 3 sigma Bollinger Bands. That initially led into the index going into first a sideways range and then a massive or a major recovery, which encompassed in 1952 for Dow. The only exception over here was in 1940, where the bounce was not as sharp or as severe. As you can see that the Dow first gave a signal of 3 sigma Bollinger Bands, then followed some bit of a further correction, but then what followed was a more of a sideways range with a very tepid kind of a bounce. Over here this is just like a 10% bounce as compared to more of a 20 to 25% bounce in the previous scenarios. And the last case over here was in 1920, where we had seen a similar kind of a juncture, where after that first round of a major sell-off, what followed was almost a 1 month of sideways range, followed by a rally up move. So which means at current juncture where we are on Friday's closing, we have given a close below the 3 sigma Bollinger Bands. If in case today we fall say by another 4 to 5% on the Dow Jones, that could be a second confirmation day that we could be hitting that major fulcrum point or a support point for the Dow, which could lead into the index going to a major consolidation and then potentially a big rally.
All right, thank you so much for that, Kunal, for putting all of that into context. But yes, given the way how the markets are shaping up, what's the buzz in the dealing room? Varun is standing by to tell us all about that. Varun?
Definitely. I've spoken to some of the dealers to understand what is the current situation between the retail people and also the HNIs. And it goes without saying that, yes, investors are cautious and they are afraid of the overall global situation that is panning out. Now, what they are doing nothing right now. They are still sitting on cash. They want to sit on cash. They don't want to take any more position. And especially those people, those who have position, are looking for opportunities to exit their position. Also, there is a big problem with people who have taken leverage to create positions. There, if you see, there are several, margin calls that are happening on a daily basis. It happens, and there are several margin calls. The pickup in margin call is higher today. No doubt, people are not ready to buy. They are ready to sit on cash. But there are HNIs who are actually buying ETFs, because brokers are also telling them to buy ETFs rather than buying, stocks, mid cap, small cap ETF, Nifty ETFs. These are some of the ETFs that have been recommended to HNIs to buy, and also there is special activity seen in ETFs as well today. Also, if you look, people are buying gold and silver. Now, gold has seen a sharp rally in last few days, but the fall in gold is relatively less when you compare to silver. So, people are buying silver in the anticipation that either gold will go down, which doesn't look like. If gold does not go down, then silver will see a sharp rise, and that's the reason there is good buying in gold and especially in silver. Now, there are two important events in front of us, that is RBI rate cut, RBI rate policy, and also the earnings season. But when I spoke to some of the brokers or the dealers, they say that people are currently not interested in RBI's policy, or they are not interested in what's going to happen in earnings. The only thing they are interested is what Donald Trump is going to say next, and that's what they are eyeing. And let me tell you some of the levels. 20,700, that is one of the level that has seen some activity in today's trade. So keep an eye on that. We are no doubt near 22,000, but yes, 20,700 level. I'm speaking about the expiry on this month end, that has seen some volume coming today. So keep an eye on that also.
For that, Varun, for putting all of that into context, what's the buzz in the dealing room, given the fact that we've seen a large or a very sharp shakeout in the markets? One of the bright spots in this market would be the fall in the crude oil prices, Kunal. I think that's the only place where I think some respite or people would have some smiles on the face, given the fact that you have NYMEX that has slipped below $60 per barrel mark. You have Brent hovering around that $62 to $64 per barrel mark.
Yeah, so so there are times when the range gets established for a few asset classes, and there are times when that range gets breached, whether it's on the extreme downside or on the upside. I think what we need to identify is that the range for crude oil is just around that 65 to 75 odd range. So maybe I think we've fallen a few dollars below those below the lower end of the band, but I believe that eventually I think we should come back into that range of 65 to 70, 75, and that what I think could also be a point where you might probably expect that many of the stocks would start to get back into a recovery. So I believe that we are at a point of an extreme, and maybe once the normalization kicks in, you could probably see the Brent crude back again into that range of 65 plus.
Okay, that's the market construct right now. Just can't take your eyes off from US futures, because it doesn't seem like the pain is out of the system. Seems like it's just begun. It's not quite close to the 2,200 point shave off that you had on Friday, but even right now it's down about 1,300 points for the Dow futures, 3.5% cut for the S&P, and it's another almost 700 point decline that I can see for the Nasdaq futures as well. And yeah, across asset classes, you are seeing a red tick. But who better than Devina Mehra right here to explain us what is happening in the world and how is it that you as investors should be looking at the ongoings. Devina, welcome to our ET Now studios. The first time, right?
I think so, at least for many, many years.
Many years. So what brings you here?
So among other things, my book.
Yes, yeah. Congratulations on what a success it's turned out to be.
Yes, thank you. I mean, that was totally unexpected that it would go right up to #1 on Amazon, all books category.
Yeah. And yeah, #1 on everyone's mind is, what is Trump up to? How do you make sense of what's going to happen and how the world is going to be maybe even 3 months from now?
Very difficult to say. I mean, when long before he took office, when he had just won the election in November, I had written a piece for Economic Times saying that whoever is predicting that this will happen to the stock market and that will happen to the bond market, what are they smoking? Because you do not know what this guy is going to do, and you are talking with confidence on second order and third order effects. And to compound Trump, you had Musk. So if you have to compound uncertainty, that's a dream team, and now you're seeing them in action. So very difficult to say. I mean, we are in uncharted territory, and the whole point is that I do not know what problem is he trying to solve with the tariffs, because the US economy was almost at full employment anyway. The unemployment rate has been very low. So it's not as if that people are not getting work because the manufacturing is getting done elsewhere. So what is the problem that you will solve by putting the tariffs? And debt is a very vague thing, because if you really put brakes on the economy, which is what he's now doing between inflation. Already, I mean, even a month ago, inflation expectations in the US had gone up to 3.5%, and now for the medium term, and now I'm sure it might be higher whenever is the next number comes out. So you are doing something which is just shaking up the economy with no real payoff. I mean, the only reason right now the labor numbers are not looking that great is because of Musk's dodge, where you are firing people right, left, and
which
center.
he may quit soon when the job is done.
Yeah, and the tariffs themselves are not rational. I mean, they are just predicated on the trade deficit with the country, not the tariff barrier of the country. I was reading somewhere that Vietnam had some 5% average tariff, and they've been hit with some 47%. So, I mean, even if they bring that 5% to zero, how is that going to change the 47%? Because it is that you can't expect look at India. India's per capita is 3% of the US. Even on a purchasing power parity, we are 10%. So, we are never going to be able to buy that many US goods. I mean, only thing we can buy now is oil. Because US is the largest producer of oil. So I think if you want to balance the books with US, that's the probably the lowest hanging fruit. So, I mean, US, as far as the markets are concerned, again, it had a very long period of outperformance, I think about 12 years or so. And for a time, I had been watching that sometime that would end. But I think Trump has just hastened the end of the US outperformance, maybe on the economic side also. I was looking at Fareed Zakaria's podcast, and he was talking about that in 1990, the European Union and US as a size of the economies were almost the same. Now US is 80% larger. Japan used to have a per capita higher than US. Now it is much lower. Even the poorest state in the US has a per capita more than that of UK and France and all that. So as I said, there was no problem to solve. You are breaking something that wasn't broken.
Yeah, fixing it in his terminology. But Devina, I mean, I understand that, and there are many, sort of analogies there that this is like the 1920s Great Depression. We don't know whether recession is going to stall here. Is it going to lead to depression in the world? Very recent examples were 2008, 2020 when COVID hit. How different is it this time in terms of what the equity markets are doing?
Yeah, but then look at what happened in 2020. That was today I posted that people are saying the news is not going to get better. So how is how the market's going to behave? I said if the beginning of 2020 I would have told you that there would be a pandemic that hasn't happened in a century, which will kill 7 million plus people in the world, which will mean that hotels, aviation, retail, autos will go to zero revenue for a year, and many other industries will also take a big hit on their revenues. How many people would have predicted an equity bull market?
Yeah.
So equity markets are not that predictable. As far as India is concerned, I do not think you are in high risk territory. As far as the large, steady portfolio is concerned, small micro caps, it's another story. That's and my stance on this has not changed in I think almost 3 quarters now. So I've been saying exactly the same thing, that get into a steadier portfolio and get out of the frothy areas of the market. And I don't think there is a huge risk, because you had a whole decade of below normal returns in that 2010 to 20 decade, which was that you put in 100 rupees in 10 years, you get 230 rupees when fixed deposits would have given you 200. So that's what created this room for the post-COVID bull run. And still you are not way above the trend line or anything like that on any parameter. So that's the plus for India. So if you were waiting on the sidelines last few months saying correction hoga, then I'll invest. So it's time to be invested to the extent of your equity allocation, which should never be 100%. Again, my stance on this again remains unchanged, that no matter how young you are, etc., equity should never be 100% of your portfolio. But whatever is your equity allocation, now is the time to remain invested. I don't see a huge downside risk, which is not to say that there could not be slightly more of a downside, but the risk reward is now in your favor in the sense that if you're not invested, you might miss out on a up move. Just as from the COVID lows, within 5 weeks, the market was up 30%. Yeah. So.
But Devina, the problem for us, and I guess that was one of the key reasons why we fell the way we did from October all the way till Feb end, was A, valuations, and B, earnings weren't matching up to the valuations that you were, giving to those stocks. Is the earnings concern now behind us or not? Or is that going to be very fragmented?
It's going to be very fragmented. That's why I'm saying that you have to look at the market in two bits. One is the large caps and one the small micro caps. That those are small micro caps in a mad bull run, a lot of stocks run. Some which deserve it, many which do not deserve it. And again, people have not spent enough time in the markets. They do not know that these kind of stocks, whether it is thematic, like last year you had defense or PSU and so on, that the stocks that do that well in a bull run, after the fall in the next bull run, those very stocks may not be the ones who which go up. So as I said, you remain invested but need not be in the same stocks or even the same strategies. Like last year, many people took money out of large cap SIPs and put them into small cap SIPs. Those are the sort of things you should not do. And also, I always say easy way to find out where there is froth is to look at where the new thematic funds are being launched, where the NFOs are coming.
Okay, so while we do dig deeper into where the thematic funds are coming, for now we're going to take a very quick break, but we will continue our discussion with Devina after this very short while. But also Tamil Nadu has ranked the highest amongst other Indian states in terms of real economic growth for FY25 at 9.69%, and that's the highest in the past 10 years. The state's GDP rose to more than 17.2 lakh crore rupees, and that was led by professional services, communications, manufacturing and construction. In fact, its nominal growth rate was also robust at more than 14% for the year. Back with closing trades right here on 18 hours, still 4% lower. I don't think it would make any sense to even go into individual stocks at a time when you've got pretty much just everything in the red. Trent is down 15.5%. That, of course, is a knee-jerk reaction that it's seen to its quarterly updates, perhaps. But look at the way some of these metal stocks are cracking. Tata Steel, 8.5% lower. JSW Steel down 8.5%. Hindalco down over almost 7%. And look at some of these large caps like L&T. Let's just bring up the intraday graph. L&T is now down almost 7% on the futures. Tata Motors, of course, they're pretty sensitive to the tariffs. Tata Motors down 6.5% right now. Axis down nearly 5%. Kotak, which has been one of the best performing, private banking large cap stocks year to date, that also is headed in for almost a 5% decline. But yes, there is Unilever. There's an Asian Paints, which have fallen relatively a lot less. In fact, Unilever is now just about bobbing into the green, or a Nestle, etc. as well. So there are those dots of green: Britannia, HPCL, Godrej Consumer Product. Well, let's see how long-lasting this trade turns out to be.
Yes, absolutely. But let's talk more about markets. Try and understand, actually, given the fact that we are in uncharted territory, but can we actually chart a new course this time around, Devina, given the fact that, yes, it's the time that now everyone is wondering what to do with their portfolio. Should they go ahead and buy in these dips and also look at reshuffling their portfolio? Do you think it's the right move at this point in time, or you should actually wait for the dust to settle?
By the time the dust settles in terms of the news, usually the market has already made its move. That's the way it is. Right. I mean, that's when I hire analysts, that's one of the hardest thing to get them to understand that in the market you always make decisions with imperfect information and with ambiguity. And so, yeah, I mean, if you look at the pattern today, of course, some of the defensives are doing better, which is the FMCG and also HPCL because of the oil price coming down. Metals, it is not surprising that the metals have taken a hit because that's not, while India is no major metal exporter, but if there are curbs on or tariffs on metals, let's say from China, India becomes one of the possible dumping grounds. So that's what is playing out in metals. So interesting times ahead. As of now, pharma, IT, auto components, all of that doesn't look too bad to us. Because that again, I mean, there's pharma, of course, there can be tariffs. He's so warned of tariffs. But ultimately, tariffs are what? They are putting India at a relative disadvantage to any US manufacturer. But how many things does India export which can immediately be manufactured in the US? Not a whole lot. And otherwise, you have to look at relative tariffs because, as my all macroeconomics textbooks tell you, that trade is not about absolute costs and prices. It is about relative advantages and disadvantages. So if you have a 26% tariff and everybody you are competing with has between 35 to 50%, then you are better off. So I don't think there's going to be a whole lot of direct fallout. But then, of course, if the US economy really goes into a tailspin, that will have repercussions on a longer term basis. It will also have repercussions on dollar as a reserve currency or the currency of trade. I mean, a year or two ago, I thought there was really no danger of any significant de-dollarization, but now I think the world will look at Swiss franc and euro and yen and a whole lot of other things as reserve currencies. But India, I don't think we are in any very dangerous territory. So, I mean, slowly you should start getting back in if you have been out, because this is a number I've given often, that in 40-45 years, if you miss out on the 10 best days of trade, you miss out on 2/3 of the returns. So if you had 100, if you had invested 100,
Not timing the market and time in the market.
yeah. So if you had invested 100 rupees, which would have become, let's say, 75,000 rupees, in 40 years you miss out the 10 best days, it will be 25,000. You miss out the 30 best days, you are down
So
to
true.
less than 7,000. That's how dangerous it is. So everybody understands the risk of being invested in the market, but there's also a risk to sitting it out. I mentioned the COVID lows. From the COVID lows in 5 weeks, from March 23rd to April 30th in 2020, both India and the US were up between 28 to 30%. So you don't know. And all these other interesting thing is all these sharp up move days come when there is fear, there's anxiety, there's people asking these questions. In a bull run, the market doesn't run that fast.
Yeah.
Right.
Yeah, there are no exaggerated moves like this. So, Devina, if someone listening to you wants to put in money tomorrow, day after, whenever, and has to construct a portfolio, say 100%, how would you divide that portfolio? And within equity, what would your recommendation be?
So your asset allocation shouldn't change every day. So that should be a broad thing which you have decided, that depending on your goals, your risk appetite, your time, your age, whatever. So all those things. And diversification should also be, I mean, let's not forget, in spite of the global turmoil today, that you should not just have only in India, but you should have global diversification also. So whatever is your equity allocation, I think it is time to be invested. So if your equity allocation, let's say, was 60 and right now you're only 40% invested. So if not in one lump sum, you should start putting it back in, so that, as I said, you don't miss out on those 10 best days.
Okay, counting down to those 10 best days. But Devina, such a pleasure having you in the studios, and hope you can make it more often.
Thank you for having me.
Thank you so much. Yes, Jay Bala perhaps would know when those 10 best days are coming, right?
Absolutely. We have Jay Bala on the phone lines. Good morning, good afternoon to you, Jay. Thank you so much for joining us. And if you look at the way how the markets are actually panning out at this point in time, are you having a tough time to decide where would the next support or the resistance be for the market, given the fact that we are seeing sharp moves day after day?
I don't have a tough time here, but good to be here after a long time. In fact, if you recall, I was here at the end of September and the beginning of October when nobody was talking about markets declining to the June 4th low. I've been repeating on ad nauseum on every media interactions all through October, November, and December, and the markets are finally here. And in fact, I had put out a note in April 2024, and the markets were when the Indian markets were facing the elections. I said, every breakout in the election year tends to come back to the breakout level that it saw in the election year, and the markets have done that. That level is 21,800. The markets are finally here. So the markets are pretty much on expected lines. I have a slight different view. People don't talk about the number of days you are out of the market, avoiding the worst days. The returns are much more better than what people ever talk about, and that can be only done by technicians. And they don't have people don't. Devina is extremely smart. She's just outstanding. But people just don't talk about this part of the market where you avoid 10 worst days. If you do that, I've even put out that during the COVID times, your returns go exponentially higher. And if you look at the markets for the last 30 years, if you avoided the bad markets of 2000, 2008, and the COVID, your returns are somewhere like CAGR for being invested is something like 11 to 14%. But if you're out of the markets, during those times, your return goes up to something like 200% CAGR.
Point taken, Jay. We'll come back to you. We'll, in fact, slip into a break on this edition of Closing Trades. When we come back, we will chart the course of the market for you with Kunal and Jay Bala. Don't go anywhere. Welcome back. You're watching Closing Trades on ET Now. If you look at the markets, a tad bit of recovery, minute one at that coming in for the benchmark indices over the last few minutes or so. If you look at Nifty, that has now actually recovered quite beautifully, in fact, because given the fact that we were actually hovering around below the 22,000 levels, now we surpassed 22,100 levels as well. So yes, a good sign, a good recovery coming in for the markets. Kunal, should we read too much into it?
Yeah, of course, why not? And especially I think with the handover, which was given to us from the global markets, our markets are mature enough, and today's reaction in the first, couple of hours of the trading, where, we were just stuck at this 900, 800 point for the Nifty for good part of the trading session. That itself indicates, that our market reaction was a lot more matured as compared to many of the other global markets, which of course are the brink of a corrective wave as such. Now, I think we've already gone through that 6 months of pain, extended pain for our markets. So maybe I think the last 6 months of correction could probably be a boon in disguise, that our markets would probably have factored in a major part of this kind of a negative news flow. Of course, difficult to anticipate that whether the global news flow subsides or not going forward. But I think with the reaction our markets are showing today, the bottom could be found much more sooner.
All right, so that's the take on the markets. We also have Deepak Shenoy joining us on the show. But Deepak, before coming to you, let me once again go to Jay and just get his views on the fact that, Jay, now what would be the key triggers to watch out for the markets, especially if you want to gauge that whether we will actually see that turnaround or we've already seen the bottom? Any key triggers that you are watching out for very carefully?
See, I'm watching two things here. Reliance breakdowns below March 2025 low, it's not a positive. And metals breakdown today, again below the March 2025 low, is again not a positive. So I'm wondering if this has got much more room to work with. And markets have approached the June 4th level that I've been projecting since September, October 2024. So, it can take a pause, and the selling so far has been a slow bleed. There's not been a level of panic. Usually, markets bottom when it registers a panic. Only today, we've seen the VIX rise, give it a spike. It's not even at the August 2024 level of 30 odds. VIX is something like 20 mid-20s on my last check. So we need to see a little more spike up in VIX before a panic can set in. But my guess is that this is unlikely to be a durable bottom at the moment. So I will see if this orderly selling that we have seen so far, if that transforms into a panic selling. So if that panic selling were to come through, then we can think of calling a bottom. Before that, it's a bit too early.
Right. Deepak, good afternoon. Thank you so much for joining us. And yes, you have a tweet that you've put out just right after the pre-open rate settled in, saying that it's going to be a crazy day. It's lived up to that, hasn't it?
Well, it started off crazy. It hasn't become crazier, thank goodness. But I think there's a lot of very strange things happening. Gold is actually not going up. In times of extreme uncertainty, it tends to go up. Cryptocurrency markets are showing a fairly large decline. We've not yet seen anything meaningful. I mean, the US markets aren't open yet, but I think there is, your Asian markets have taken it on their chin as well, apart from India as well. So I think to that extent, we might actually be seeing a lesser reaction compared to the US or the rest of the Asian markets, especially over the last 3 trading days. We may be down maybe 4.5% in total, but the US is down more possibly 15% in this time frame. So yeah, I mean, relatively less, hit, but a hit nevertheless, and hasn't gotten worse intraday, which is a good thing.
Absolutely hasn't gotten worse the intraday, and we have yet to see the open coming in for US markets, given the fact that the futures are pointing out for another 1,000-odd point cut coming in for Dow futures. But Deepak, during this sort of an uncertain environment, because you don't know when you wake up next morning what new tariff will be imposed, what new commentary we'll get. Today, Donald Trump called the entire tariff as a medicine that was required. So what's your take? What should one do? How should they actually go ahead and reallocate or realign their portfolio?
So I think at times like this, if you look at a macro concept, you can't predict what's going to happen. So I'm not even going to try. All I know is that there are lots of stocks which have been on our watch list for years sometimes, and many of them have been outside the range of the prices that we wanted to buy them at. And perhaps this will give us an opportunity to buy them at those ranges. We continue to be buyers where, there is a significant value that is available to us in terms of our prediction of future growth, and aligned, of course, with the rest of the world. Today, we've largely had an domestic India kind of a investment policy in our fundamental portfolio. Now, I think there nothing major has changed, because if you're making stuff domestically for India, unless India forgoes all its tariffs, this will continue to be a very strong market, very strong place to invest. So I think at this point, if you're an active investor, this is a great opportunity to realign portfolios. We've been doing that over the last 3 months, shifting away from stocks which are relatively higher value to a point where we can get into new stocks that we wanted to get into at lower valuations. And we continue to do the same process. I think long term, this is all very bullish for India, because in the long term, I think India will come out stronger and victorious. In the smaller time frame, a lot of bad things can happen, and maybe that's the time you just have to close your nose and run through with the portfolio without having to market your entire life every day. That's the job of funds and people like us, of course, all the time. But every individual doesn't have to do it.
You did say that you're realigning the portfolio, trying to actually get in some good stocks at these prices. Which sector would that be actually that you're looking at this point in time? Because all you can see is blood on the screen. You don't know where to put in your money. You would not want to miss the bus. That's actually what every investor at this point in time would be thinking.
Yeah, I mean, you don't have to jump and hurry it, because it's like the first day of a fall. It may be 2-3 more days. It may be a massive recovery tomorrow. We don't know the answer to that. The tariffs start from the 9th, and you even before that, and they could suddenly decide to postpone the tariffs because not enough countries are playing ball. China has refused to play ball already, and China is the only country that matters to the US meaningfully, because they can't substitute China in any meaningful way in the next year or so. And without China playing ball, America is going to see a significant amount of inflation with the tariffs they're putting on them. So I think given this, you're going to see a lot of volatility, both down and up. If you find stocks coming into good valuations, that's when you should buy them. But, it's not like you should hurry and jump into anything just yet. But what I feel relatively unaffected is stocks that are, manufacturing in India for India. Manufacturing in terms of, say, defense, auto ancillaries, if you may, and all of that, I think they will continue to do well. Of course, some of the tariff changes may impact them, but I think by and large, they will continue to do well. There will also be a bunch of other stocks in domestic infrastructure, domestic consumption, financialization. These are trends that I think we will see, go to the next decade, because we will continue to grow in all of these areas. And so, when those stocks come down to a much more reasonable value, it's worth increasing your position size on them. It's worth increasing your, investments in them, and taking out from some sectors that may be affected. So we're doing this. We call this Surge India, if you may, and we're actually increasing allocations to companies that are making for India and making in India. So I think that I think is undoubtedly a future that will be brighter in the next decade.
India, make for India, the themes that actually Deepak is liking at this point in time. A short while ago, you had flashes on the bottom of your screen which mentioned that after Trump, you have European Union that is seeking about zero tariff from India on car imports. However, the government is open to phase cut on car tariffs to 10% from 100%. This is all source-based information that we are getting from via agencies. However, the car makers back home have proposed minimum 30% tariff on limited imports. So this sort of a move, and in case we go by that tariff cut coming in for the auto car imports, then it will be a win for Mercedes, but it will lose, the companies that will lose out on that would be Tata Motors and Mahindra back home. But talking about tariff, you have the Commerce and the Industry Minister Piyush Goyal that is likely to meet exporters and industry on Wednesday. This in order to get their feedback and brief the exporters on the 26% reciprocal tariffs that the US has imposed. I have my colleague Sumit who's here to tell us all about that. Sumit, over to you.
At a time US tariff war has spooked global markets, India's Commerce Minister Piyush Goyal is going to meet exporters this Wednesday. The meeting is likely to discuss a host of issues, including, first of all, impact of US tariffs, what difficulties exporters are witnessing, do they need any more government help to carry on with their exports, and what overall is the view of Indian government. Remember, Indian government is carrying on a bilateral trade agreement with US. India is the only country that has got this window. This BTA has to be finished by fall of this year, and from that point of view, meeting with exporters is very important as well. Indian exporters from the sectors like pharma, gems and jewelry, and other organizations will be present for this meeting. So in a way, this meeting assumes significance because it's the first meeting after such sweeping reciprocal tariffs have been announced from the US side. India cannot do that, and India is in no mood to go for replying on these tariffs, tit for tat tariffs. But feedback from exporters is important because that will form the base of what steps India will take going forward.
All right, thank you so much for that, Sumit. Definitely will watch out for details coming out of that meeting. Coming to you, Jay, then, you did mention briefly about Reliance Industries. I just wanted to understand from you on the charts when you talk about these metal counters, especially the ones that are getting hit hard in today's trading session. How should one actually look at the metal space? And what's your gauging on this one? Because yes, mostly why metals are also getting impacted is what exactly happens with the tariffs on other nations, not just India.
Yeah, this is a bit fundamental and beyond my pay grade, but for whatever I've understood from what Ray Dalio said, I'll spell out for you. The country that imposes tariffs are inflationary for them, whereas for the rest of the world it's deflationary. That's the reason why it's a bit perplexing for what, like Deepak has pointed out. Gold tends to fall during a deflationary environment. So that's the reason why gold is not going up, and Bitcoin is also going down. And I've pointed this out in my YouTube video just about 3 weeks ago, that gold could have probably clocked a multi-decade high, and metals, like the question that you point out here. If you look at the SPDR metals and mining ETF, it's got an important breakdown at Friday's close. So it's expected that Nifty Metals Index is actually dropping sharply, and 7100 is a very important support for the Nifty Metals Index. That has a very important bearing for the medium to long term. If that were to get taken, already it's below an important price channel that it's clocked from 2022. So it's signaling further deterioration here. So we are in a deflationary environment where only cash and cash equivalents are looking safe at the moment. What we are watching for now is that the world order, which is trying to change here, we are trying to see if India can, cut off from the, rest of the world synchronization. In a strong downtrend, the world sinks and swims together, and that's what we are watching for. If that change is actually coming through, so far it has not come through.
Yes, getting breaking news at this point in time, the fact that the government has gone ahead and hiked the excise duty by 2 rupees per litre on diesel and petrol. Deepak, it's coming at a time when ideally we should have expected some relief, not an increase.
What to say? It's just very strange, the happenings that seem to. I mean, we could have enjoyed the benefits of it by a lower petrol price and a lower diesel price, but I think that's too much to expect because honestly, we've not been given the ability to enjoy that for the last 3 years, even though petrol price, I mean, the crude oil price fell a lot. I believe here, there is it's a differential treatment, I think, for us. But what it does mean is that there'll be other areas where it reduces in terms of cost. Plastics cost will reduce. There'll be a little bit lower transportation cost. Airline fuel surcharges may, hopefully will come down. But I don't know if duties increased on that as well. But I think we should have. Been given some of this opportunity. Hopefully, the government will reduce it in some other way. I mean, a bigger thing would be to cut GST. Hopefully, they'll use this as a mechanism to cut GST as well. I can't see the logic of increasing duty at this point when there's so much uncertainty. So hopefully, the government has something else in mind.
Exactly. In fact, hoping that given the fact that, like you mentioned, Deepak, we've not been able to enjoy the lower crude oil prices when each time the crude prices have actually fallen. We've not been able to enjoy lower petrol or diesel prices here. And in fact, this sort of an excise duty hike is coming at a time when there's such uncertainty in the environment, and at a time when you have crude prices globally that is down, and also you have the tax cuts that we are hoping to benefit out of that was announced in the budget. This excise duty hike actually kind of that one also will take a hit, isn't it? The cash that you expect that would be money in the wallets of a lot of consumers on back of the tax cuts. Now, given the fact that you have a hike coming in excise duty, you worried whether you can enjoy it or no?
Well, you will get the same price of diesel and petrol. That's the point. If crude has fallen to $60, your petrol price would have naturally come down at some level. And instead of bringing it down, they have said, well, you bring down the price if you want, but we'll increase the excise duty. And therefore, you'll pay the same price at the petrol pump. So it won't increase the price that you pay for petrol. It will be exactly the same, just that you could have got a reduction, you're not getting it. So I don't think it'll increase your cost. So you'll still make this 1 lakh rupee tax saving per year, or whatever that number is. But you will not be able to enjoy a lower price of petrol that your friends in neighboring countries or in UK or Europe or something like that might actually enjoy because they allow the price to fall.
That's a good clarification coming in from Deepak. Right now, if you look at the OMC prices, they've all OMC stocks, they all have actually taken a knock from the day's highest point. We have Prakash, who's here tracking the story, joining us on the phone lines right now. Prakash, the government has gone ahead and in fact hiked the excise duty on petrol and diesel.
Yeah, of course. It's an important development. The government has decided to increase basic excise duty on petrol and diesel by rupees 2 per litre, and that is applicable from April 8th. So essentially, excise duty on petrol has been increased to rupees 13 per litre, and diesel it has been increased to rupees 10 per litre. As you are aware that the crude oil prices has there's a significant reduction in crude oil prices in the international market, and we're expecting that the government and the oil marketing companies will provide some respite to the consumer. Instead, the government has decided to increase excise duty. So, of course, the government will collect some more revenue going forward. But the interesting question at this point of time is whether oil marketing companies will provide some relaxation in terms of petrol diesel price reduction to the consumer. So that's an important development. But however, we try to approach some of our sources in the oil ministry, and they are saying that some good news may come going forward. Oil marketing companies may provide some relaxation to the consumer in terms of reduction in petrol, diesel prices. The good thing is that they are making profit on sale of petrol and diesel now. There is no such under recovery. Yes, the only deterrent that is coming in a way of reduction in prices are their losses on sale of LPG. But that's a different story. But the point is that the government has decided to increase excise on petrol and diesel. We are also learning from our sources that the oil marketing companies may reduce prices of petrol and diesel, and that the announcement may be made very soon.
So that could be a silver lining that everyone is hoping to see very soon, Prakash. The fact that most likely your sources are indicating that OMCs may go ahead and look at that fuel price reduction, at least for the consumers. This is what the source-based information Prakash is picking up as of now. No doubt the government has gone ahead and hiked the excise duty by 2 rupees per litre on petrol and diesel. But what his sources are indicating that the OMCs may actually look at reducing the fuel prices as well, which will be a win-win for consumers, isn't it, Deepak?
Sorry, you meant the fuel price increasing,
No.
the fuel price decrease is a good thing?
Yes, the fact being that the sources have indicated that the OMCs may reduce the fuel prices, at least for consumers. So, yes, we hoping that we'll get some good news on that front now.
Well, I mean, it's been a long time coming. The price of crude has fallen to less than 70. It was at 95 or something when the fuel prices were exactly the same. It fell to 70. We saw no price increase and no duty change by the government as well. And the oil companies did not give us any discount because of that. And then now when it's fallen to this below 70 levels, they've chosen to give us a little bit. This feels like it's not like a really even market. Somebody else is deciding the price when a market should be determining the price. But fine, we'll take whatever scraps we get, I guess. I'm going to be happy if we get a lower price. It will actually help reduce inflation and the impact of any depreciation of the rupee that would have affected us in terms of inflation. So yeah, the rupee is up about 40 paisa today. So therefore, it's about a 0.5% increase in the cost of things. But by and large, if we get a reduction in the cost of fuel, we might actually see lower inflation going forward as well.
All right, so all fingers crossed on that particular front. But as we are heading towards winding down the trading session, Kunal, let me quickly get your BTST ideas for our viewers.
So in terms of BTST ideas, I'll go with 2 buy calls. The first one is actually a buy on Tata Motors. My sense is that the stock could probably have formed a near-term bottom for itself. So would suggest a target of 620 for the stock. Stop loss could be kept at 550. And Reliance Industries is the other stock which I strongly believe is at a very attractive juncture, just closer to that 1155.60 mark. So look out for targets in the range of 1200. Stop loss at 1125.
Right. Jen, let me get a final word from you, and I just try and understand from you, if you are looking at the charts very closely at this point in time, any sector that you are liking at this point, and which one would you actually try and gauge more deeper?
I like the chemical sector at this instant. In fact, at the top within that is Saraf there. But given the market's turmoil, I'm very happy, staying on the sidelines. And see, bottoming is a process; it's not an event. So bottoming gives you enough time for the markets to settle down. And I would any day be outside the market, regretting that I was inside the market, rather than be inside the market and regret that I should have been outside the market. So with that caveat in mind, I like the chemical sector.
Chemical space is looking attractive on the charts. On that note, thank you so much, Deepak, as well as Jay and Kunal, for joining us on the show to talk about the markets as well as the way forward. If you look at the markets very closely at this point in time, looks like we are actually going to shut shop near the day's highest point, given the fact that we've seen a recovery of about 480 points when you talk about the Nifty. Let's take a look at Nifty Bank as well, because the recovery there also is pretty healthy. You have the Nifty Bank that's recovered about 839 points from the day's low. So some sort of recovery creeping into the markets. Remember that if you look at the way how Indian markets have fared when you compare it to the Asian peers, we've outperformed most of the Asian peers in today's trading session. But all eyes will be on how the US markets actually open for trade, given the fact that you have the Dow futures that are indicating a cut of about 1,000 points already For the Dow, remember you have a silver lining coming in, that's the crude oil prices that have seen a sharp knock. But we have Snehi over there standing by to actually give us a roundup of the market closing. Snehi, over to you.
Well, absolutely. Let's take a look at how we fared in today's trading session. It started out on a very weak footing, very somber note. From the day's lowest point, we have seen a recovery of roughly 200, anywhere between 250 and 300 points from the day's lowest point. We are closing around the 22,200 mark. Remember, at one point of the day, we had slipped as low as 21,800, 900 levels, sub the 22,000 marker, that is. So we've seen some recovery from the day's lowest point, but nonetheless, it's a 3% cut coming in on an intraday basis on the Nifty. Sensex in tandem with the Nifty, 2.7% cut coming in on that front. Advance decline ratio, at least from the day's lowest point, some stocks have managed to move over to the advances, because at one point we had only 88 stocks in the green and the remaining in the reds. At least that picture has fared up a little bit, but India Wix is the one counter to talk about today. And look at that spike coming in, a 67% spike coming in on an intraday basis. We're at the 23 mark when it comes to India Wix. Let's take a look at what Nifty Bank has done in today's trading session, and a 3% cut coming in on Nifty Bank today as well. So that's also a sector that has not done well. In fact, 1,500 points cut on an intraday basis for Nifty Bank. While the mayhem continues for today's trading session on the broader end of the markets, Nifty mid-cap was lower in today's trading session along with small cap. Mid-cap saw a cut of in excess of 3.5%. Small cap also over there, 3.5% cut coming in for the small cap index too in today's trading session. Let's take a look at sectorally what's done well and what's not. In fact, all the sectors have ended in the red today. The biggest loser was Nifty Metal, almost a 7% cut coming in on Nifty Metal, and names like Nalco, Hind Copper, Tata Steel, JSW Steel, Jindal Steel, all of these stocks were out today. While we're talking about Tata Steel, that's not the only Tata group of Tata stock that was out today. Talk about TCS, Tata Steel, Trent, Tata Chemical, Tata Communication, all of these Tata group of stocks were down in today's trading session, particularly Trent, a free fall not seen in the last 4 years for a stock like Trent on the back of a very weak set of quarter 4 updates coming in, and a rating and a target price cut coming in from Antique. They've kept the rating as the buy for Trent. Let's move on and talk about some other stocks that were in focus in today's trading session. Delivery on the back of the acquisition of Ecom Express, that stock was in focus. Jubilant, Trent, GCPL, all of these stocks in focus on the back of quarter 4 updates coming in. Nykaa, good set of quarter 4 updates coming in. Same for Macrotech. They've crossed their FY25 guidance, but that stock has also given into market pressure and was extremely low in today's trading session. Utkarsh Small Finance Bank, poor set of numbers coming in, and Tata Motors on the back of the brokerage note, as well as the pause announced to the shipments to the US for JLR. That's roughly how we are ending today's trading session. At least we are above the 22,200 mark on the Nifty. So that's a bounce back from the day's lowest point, but nonetheless, almost a 3% cut is what we are going home with.